Hello, hope you're all doing well. Today we're going to look at chapter 13 of Global Strategic Management, and that is on global financial management. This is a key element of business. Finance has evolved a lot since, over time, and especially since the 80s, where traditional financing areas of issuing promissory notes or taking loans, which have been around forever. But there are a lot of new ways that people have obtained financing and looked at financing, and especially with the globalization of the markets, if you come to found ways to take advantage of different pockets of financing, different ways they can manage their money around the world, and using the systems available in different places. So it's very interesting, and you'll see a lot of, not every company will have a finance department, a chief financial officer, etc., where they really look at the key elements of how and where the money is, how to protect the positions of the financial position of the company through various means. And it's a big part of the business, especially when you work globally. In the U.S., we're fairly used to stability, and over most of your lifetimes, you've seen a rate scenario which has not changed that much. When you're like, I remember when short-term mortgage rates were 15, 16, 17, not short-term, I'm sorry, mortgage rates were 15, 16, 70%, and short-term borrowing rates for 6-month trade finance, over LIBOR were like 20, 21%. So that's completely different from a more stable environment which we've had for many years. So in the States, we're used to some fluctuation, but within parameters. Other countries, when you work globally, you'll see things swing all over the place, like we see in Venezuela now, and many other countries in the past. So it's quite a challenge, and it's fun, but sometimes, many times, the way you manage the financial management of the company has a bigger impact than selling or the product or acquiring the material to sell the product. Those cost revenue factors can be way overshadowed by management or mismanagement of the financial position of the company. And that's what we're talking about in this chapter. So if you look on with 3, it looks like slide 3. Please do call up the slide presentation for this as well, because we're going to follow along on that, and there's some good things in there. But basically, what companies are looking at when they look at financial risk are a few things. They're looking at currency risk. Currency risk is exposure to the difference between currency in a foreign country and your own, and and how that matches up. And it's pretty obvious that if currency in one country is devaluing much faster than the currency in your country, that over time it's going to be worth less when you bring it back to your head office. So you need to figure out ways on how to manage that. So the currency risk is real. The other currency risk sometimes is you might lend in one currency and ask for repayment in another. And you can flip that around the other side. You may borrow. You're in Peru, and you're borrowing dollars. Unfortunately, in Peru, you can pay back in dollars too. But say, for example, a country where you borrow in dollars, but your local obligations, and then or where you're lending, or what you're putting out as credit, is in local currency. Getting that back, converting to dollars, and repaying, you're subject to the fluctuations in the currency. So these are all things to worry about. Liquidity maintenance, you have to have cash. Liquidity is a key to sustainability of your company. And even though your company, for example, may be really a great company and have a long-term potential, if you miss your upcoming payments and your payroll, for example, it can damage your company. Where to borrow, how to get funding, funding cost, cost of funds, funding ability, access to funding. All these things are highly important to a company, and they can be, of course, they lead into liquidity and other things, and how you're perceived as a company if you have sources of funding. And then we'll look at project finance. Project finance is interesting. Is how to evaluate the projects you do. Project finance usually covers longer term projects where you're trying to obtain financing or trying to fund somehow your maybe you're going to build an electrical plant in some country or some big manufacturing facility, or a new toll highway or something like that. These require different types of funding and a different concept because it's longer term, and the proceeds, the way you get paid back from that is not going to be what that project turns out in the next 6 months. It may take years before there's a return. So how that project finance is structured and where you get the funds from and how much you're willing to pay for that are all key things if you're in that business. Then the capital structure, how to raise equity, even the way equity is calculated in different countries is different. Some countries may look at all the components of equity in one way, others different, and sometimes certain parts of the equity mix are treated differently based on legislation in terms of, are they revalued according to inflation or not? Are things held at historical value? Are allocations from owners treated one way? How are retained earnings? So all these things that go into capital structure, and also the risk elements of that capital are different from country to country. They're becoming much more similar than they used to be, but with different the Basel regulations, et cetera. But still, there are differences. And then there's trade finance. You have the traditional elements, ways of financing the transfer of goods and services to one country from another. Let's look quickly at currency risk. By definition, when you work overseas, you're going to be exposed to that, and your competitive advantage can be helped or hurt by that. Many times, a good, like we were saying before, a really good finance manager or treasury department in a country can make or break you. They can really be the ones that keep you in the game, or by just not doing anything or not doing anything fast enough, you can really lose it. Sometimes, you have countries that have a devaluation. Overnight, they might devalue the currency by 30%. If your treasurer has been in the right instruments, that doesn't hurt you. If it's been a wrong instrument, it can wipe you out. So these are the kind of things that happen to people, and it becomes extremely important to manage your currency. Also, you have to think about, when you sell in one currency and expect to end your payments in another, or obviously the more you can keep what you borrow and what you repay and what you sell and what you buy in the same currency, it's better. But sometimes it's not possible. So then you have to use different mechanisms to hedge that. The other thing that can be is the translation exposure. That's basically on your balance sheet. Balance sheet management is really important, and sometimes the different components on the balance sheet can be treated differently in different countries in terms of how they're valued. For example, in some places, the physical real estate that you own, so maybe you're a bank in a certain country and you own 300 branches. The land those branches may or may not be automatically revalued based on inflation, and that'll have an impact on your balance sheet. It might be held at historical cost. It might be revalued by law every year. A percentage may be revalued. So your balance sheet could have hidden value or could have overvaluation depending on the legislation. And so these are all really important things. Each category in the balance sheet needs to be understood, and how it's how that is valued. And if it's straight up, fine. A lot of times things are becoming much more transparent, much more clear. But will be pockets of difference in different countries, and it's really important to know that so you don't get the translation exposure of those balance sheet items. Hedging. What companies do in order to mitigate those risks, they employ various hedging mechanisms. I'm not going to go into those in depth. I'm sure you've had other finance classes where hedging mechanisms are more fully developed. But the main thing is a good treasurer and finance officer, etc., is going to identify where those risks are, and then try to mitigate that. Sometimes your mitigation will be, I see it, and my projection is that it's not going to have that much damage to us, and I'm going to leave it alone. I'm not going to worry about it. For example, I'm borrowing 30 days tenors in this currency, repaying this. I'm willing to take that risk for 30 days. I wouldn't do it for 5 years with S currencies, but for 30 days, I think I can see far enough into the future in 30 days to say that that's not a big risk. I'm not going to hedge that. my borrowings for 5 years, I'm going to do a foreign currency contract and hedge that risk. That's different. So the main thing is to identify it, understand it, calculate, evaluate, put a number around it, and then see whether you need to hedge it in a cost-effective way. Sometimes the hedges can be so expensive that they're not worth it, but that usually is a reflection of the risk you're taking if you don't do it. So some hedging tactics are more even physical moving of your operating facilities from one place to another. If you're in a very volatile rate market, where things go crazy all the time, sometimes it's very difficult to do budgeting, very difficult to do anything, and you may just consider, look, I'm just going to put my plant and my people somewhere where it's a little less volatile, a little more stable, and that'll automatically hedge that exposure just by being somewhere else. Another thing is purchasing inventory of durable goods. When you're if you've ever lived in countries where there's a very high level of inflation, sometimes people will buy physical things like, of course, property in the United States even, but sometimes just washing machines. Because a washing machine, you buy it now, or if you don't buy it next week, it's going to be that much more. So a lot of times you'll buy physical things with a devaluing currency, because next time you go it'll be higher. And the same thing with a major corporation. What you can do is take that local currency which you feel is devaluing and buy inventory. Once you have the inventory, then the inventory rises along with inflation, but you've already bought it. So a hedge with a devaluing currency is to procure the elements of production at where they are now, if you suspect that it's going to go up later, especially if maybe in some countries on the other side you'll have price controls of what you sell. So the more your inventory goes up, it affects that. So if you lock in that inventory at a good price, you have it there, then you can control your exposure much better. Distribution of sales, investment assets, all ways of portfolio management. You just have to be very careful, look at each thing and how they're impacted by the things. And then you can buy options. An option is you're buying the right to buy or sell a currency, a call or a put, depending on if it's buying or selling, at a given rate at the end of a period. So most of the time, managers will use this, buy options, currency options and currency swaps, if they really have a solid view on where it's going. Options and swaps are based. They're not like, you can't call them a bet exactly, but they're basically a prediction based on knowledge, and on both sides, the seller of the option, the seller of the swap, and the buyers, they have a view. And usually it becomes in a free market and an open market and currencies that are well known, it becomes established that we all think this. So you'll decide to whether it's advantageous to your company to buy that option or buy that swap. And many companies will do that in order to, because the thing is, you may limit your earnings, but you know what they're going to be, and awareness and knowledge and be able to project and predict and budget are very strong motivators for doing hedging. I'll go switch over to project finance. Project finance is provided by your company resources, your own cash the company has, and other investors, or you issue debt or you borrow. The key, a really interesting thing here is when you look at project finance, particularly in countries where their infrastructure needs to be met for a lower income and a general population, you can get support for them from various organizations. They're listed in your book, many of them, but you look at things like the development banks, the IDB, the World Bank, various multilaterals in different countries. Multilaterals are often jointly owned by the government and other governmental entities, as well as sometimes by private institutions from outside the country that get together and enjoy a certain status that what you lend to them and what they do may be guaranteed either 100% or to some extent by the host country. There are credit risk insurance. There are all sorts of things like that you can use that are sponsored and helped and may be promoted by local governments to try to do that, to try to get these infrastructure projects in place. Project finance is a lot of fun, and I think that working for the IDB, World Bank, and other multilaterals can be quite an exciting career. I've worked with a lot of these organizations in the past many times, and known a lot of people there, and it's fun. It takes a while. It takes longer to get a project going because they're big, but there's a certain satisfaction when you go to some place in Ecuador and you look out and say, we've worked on this irrigation thing that now for thousands and thousands of acres of irrigated land and producing crops that are keeping hundreds and hundreds of people employed and living a better standard of life is rewarding. So that's what these guys do, and I think that's when you look at project finance, you're going to involve these other agencies to mitigate the risk and allow for the longer tenor that these projects usually need. Global capital structure, again, I'm just going to go quickly that the idea is to minimize the cost of capital, enhance the value creation. It's difficult in your own country, more other places. I'm not going to go into this that much, but basically your global capital structure is to try to optimize the investment that you have in that country or in your country and how it's treated in your foreign countries if you're in a multinational corporation. You have to look at all the components of the equity, how they're treated by the regulatory and the tax and the finance structure in that country, and see how to maximize that. And capital markets are usually not fully integrated. Even how you borrow, some types of borrowing will go into equity, sometimes it won't. Certain things, so you have to just know what you're doing. Have good local accountants and really good quality people that look at that, so you can make sure your capital structure is solid. It's the foundation of your company, and it can, if it's not really solid, it can affect you. Trade finance. Trade finance between countries usually requires finance to cover the costs and times of the import-export of goods. And the simplest thing is agriculture. Say you're selling soybeans from Brazil. The soybean producer, they're gonna plant the soybeans. They're gonna watch them grow. They're gonna harvest them and sell them. They'll need a couple types of financing. You want to finance before they need money to plant. They need money involved in the initial, that time when the plants are growing. Then they're going to need money to harvest and to ship. So, and then the buyer may need financing to buy. So you have, when you're a trade finance bank or trade finance of some kind, you have some different elements that are very interesting to work on. They're very short term and they're very clear. So, for example, that it makes sense that somebody would need financing to plant and wait that time while it's growing. They don't have any revenue, but they have revenue coming up. So you can lend on day one, and when they make the sale, you can get repaid. A lot of business is done that way, and it works out very nicely. On the other side, people that are buying, they want to buy the soybeans, but haven't sold them yet. So what they need to do is they buy the soybeans, then it gets shipped. All that time while it's shipping, the financing gets there, they package it, warehouse, etc. Then they sell. So there's a gap. There's a trade finance gap that they need financing for. This is great business. It is lucrative because you do a lot of it. And the other good thing about trade finance is that you almost always get paid, because it's highly detrimental to a company or to a country if their trade finance obligation not paid. So most banks will do trade finance willingly, readily, because of the overall safety involved and also the clarity of what's happening. Also, there are all sorts of documents that you have in place that evidence and manage all the components. So you have letters of credit, you have bills of lading, you have all sorts of other documents that you can see that the goods are where they're supposed to be, they're being shipped according to and most governments will support and be very clear on the monitoring, especially on the export side of what's being exported. And then on the import side, they want to control what's being imported too. So the whole thing is fairly, is a nice business. Letters of credit, won't go into that too much, but basically a letter of credit is there for banks that know each other to help their buyers and sellers obtain credibility. Because you may be selling to another country, you don't know, I don't want to ship my goods there and trust that buyer to send me the money. And on the other side, the buyer's thinking, I don't want to pay this money. What if the guy doesn't send me what I'm expecting? So as a letter of credit puts banks in the middle where, as a seller, I'm going to get paid from my local bank, and the buyer says, I'm going to pay my local bank. And the two banks know each other. They have a relationship, and they trust each other. So the payment, it goes like that. The buyer pays his bank, the bank pays the other bank, and that bank pays the seller, and everybody's happy and can accept the risk that they're taking without. And then over time, the buyer and seller may get to know each other. They cut out the banks and sell an open account, and that happens a lot. The export credit agencies are fascinating. I've worked an awful lot with them in the past, and we have in the States Exim Bank, but in almost every industrialized country they'll have a similar thing to the Exim Bank, which is basically a government or government-sponsored organization that helps the export of goods and services from their country, and it's done under different ways, but that's the basic idea. Usually there's a content, like from the Exim Bank, they require X amount of U.S. content on the thing sold. Other countries are more flexible. For example, like the export agency for Norway, as long as it is to Norway's interest, they'll support it. For example, it might be a Norwegian company operating in China selling to the U.S. There's nothing about Norway in the production, but it's a Norwegian company, and you can get financing support. And that finance support is the following. The way that works in the Exim Bank and these other, COFACE from France, ECD, England, Hermes from Germany, SACE, although they either provide loans themselves to the exporters, or they guarantee loans that banks make to the exporters. And that's a very helpful. Exim Bank, for example, if you're selling machinery to Mexico for 5 years, and they'll guarantee that 100%, so that you can, if they approve it, you can, as a bank, can make that loan to the borrower in Mexico, and they'll pay. And if they don't pay, you turn to the Exim Bank, and the Exim Bank pays you. So that's the way that works. It's fun business, and it does benefit and generate greater exports from the countries. It's become very political lately, which I think is unfortunate. But I think that these places have a place, and I have to say that our own export agency is under a lot of pressure, because the other ones are much more aggressive. The desire for the other countries to support their exports is many times stronger than here it is in the U.S. Next slide, slide 9, about the U.S. dollar. The U.S. dollar is powerful. 64% of country reserves are in dollars, and that's around the globe, and where 20% are in euros, and 65% of all dollars are actually outside the U.S. Many of you are from foreign countries, and you know that a store of value is among diamonds, gold, property, etc. One of them is a dollar. So people just have dollars, and they have those as a store of consistent and fairly reliable source of funds. 85 of foreign exchange transactions involve dollars. So in other words, when you do foreign exchange contracts, it's dollar on one side against another currency, and 40% of the world debt is issued in dollars. All these are way down from what they were before, but they still show that the preponderant currency is the dollar, followed by the euro. Interesting to see that a 1% dollar appreciation against all other currency in the world is a 0.6 to 0.8% decline within a year in the volume of total trade between countries and the rest of the world. So you see, people are really upset when the dollar goes up in value around the world, because everybody else gets affected. We're better off because we can buy things a little more cheaply, but it has a huge impact around the globe. And that's why we're always pushing for other countries to have floating currencies. It makes it more fair. But you see the power of the dollar. So just to reiterate, 64% of reserves, financial reserves, that you look in their balance of payments that are held in their central banks, will be in dollars in around the world. This is an interesting bank. If you look on slide 10, this bank, Monte dei Paschi di Siena, I've visited this bank many times. It's really fascinating to see. That's where letters of credit were invented, and all the way back. And this bank was formed in 1624, but it goes all the way back to 1472. So it's just fascinating to go into this bank, the head office there, and see basically the oldest bank around. And they invented the letter of credit way back when. So it's a lot of fun to see that. I already talked about letter of credit. I'm not going to go over that too much. Um, Finally, the last little thing I'm going to talk about is a global taxation. Again, a big part of the tax reform in the U.S. is to encourage companies to not hold so much money overseas, and you see that in 2016, the European Commission imposed a $14 billion penalty on Apple for they didn't pay their taxes correctly. There's a lot of money being held by Apple and others offshore because they don't want to repatriate it and pay taxes, which is changing now. But with all that is to say that a big part of financial management is to look at the tax issues, how things are being taxed in different places, what the tax rates are, and it can again make or break a company, and it can make a lot of difference on whether companies bring the money back to the U.S., keep it overseas, where they're set up, where they're structured, and everything. So your tax accountants and tax lawyers become a very important part of the overall financial management. Okay, so that's it. So the main thing I think looking at is the different financial risk, and the summary of that is to just be really aware of everything that involves that. From your balance sheet to your transaction flows, your sales, everything. Because the components of that, the currencies that are used, the time they take, the hedging mechanisms that are possible, how capital is judged and evaluated and managed, and how just the different components of the balance sheet, how each one of those gets treated in these various countries, all come into play on how you want to manage the financial position of the company overall. Thanks a lot. Talk to you soon.